Hey everyone, as I've highlighted in the past, commercial real estate investments usually deliver stable returns over longer hold periods, usually a 5+ year horizon. That allows time to iron out common cyclical bumps and potholes that may affect single-year returns. In times when the economy and sector are relatively normal, like between 2014 and 2019, most property types delivered total revenue growth between 20 and 25%. To be clear, I'm defining the term revenue growth as the change in the average occupancy times the change in the average rents over that span. And while it's generally true that commercial real estate delivers relatively steady gains, there have been times when the sector has faced a severe disruption, like the global financial crisis. Revenues peaked in 2008, then went through a roughly 2-year down cycle. Apartment revenue losses were comparatively mild, and they recovered fastest. Hotel revenues made it back to their pre-recession level in 2013, while office and industrial properties recovered to pre-financial crisis levels in early 2015. As for multi-tenant retail, well, that's a different story. The retail sector took much longer to recover from the global financial crisis, about 10 years, because of significant retail overdevelopment and because of the rise of e-commerce. But by the same token, there are times when commercial real estate revenues accelerate. For example, average industrial revenue gains were 11% in 2021, and they were nearly 18% in 2022. So barring a major event like the global financial crisis, revenue growth of most commercial real estate properties tend to move at a relatively steady pace. Between 2010 and 2020, apartment revenues increased by 58%. Hotels delivered a 60% gain. Industrial climbed by 49%, downtown office rose by 44%, and suburban office went up by 27%. The laggard was retail, which spent much of that time reinventing itself. Multi-tenant retail revenues advanced by about 11% over that 10-year span. But the relatively steady 4 to 6% annual gains we experienced over those 10 years were completely disrupted by the COVID pandemic. The health crisis had a huge impact on the sector, and each property type experienced a unique reality. And while everyone thought retail would be one of the hardest hit sectors, it actually delivered some of the most stable revenue gains, advancing about 10% over those 3 years. Hotel revenues, on the other hand, were hit hardest by the COVID pandemic. In the span of a year, hotel revenues were cut in half. But the next year, the sector bounced back, with RevPAR almost fully recovering to pre-pandemic levels. And the gains continued in 2022. As of the first quarter of 2023, hotel revenues stood 16.6% higher than they were in the first quarter of 2020. Then there's the office sector. Of course, everybody remembers when COVID came and we all packed up our laptops and headed home. The thing is, a lot of people haven't gone back to the office since. And as a result, downtown office revenues now stand 11% below their pre-pandemic level. Suburban office has done better. Average suburban office revenues have basically remained stable since the onset of the pandemic. But two sectors have taken off like a rocket since the onset of the pandemic. The pandemic-driven surge of e-commerce sales, together with increased retailer safety inventories, drove industrial space demand. From the first quarter of 2021 to the first quarter of 2022, industrial property revenues increased by 14%. Then over the next 12 months, they climbed by another 16%. But it looks like the pace of industrial revenue growth will level off over the next couple of years as e-commerce sales flatten, retailers reduce their safety stocks, and as a record 400 million square feet of additional space is added this year. And finally, there's apartments. From the onset of the pandemic through the first quarter of 2021, average apartment revenues fell by about 1% as eviction moratoriums and other challenges impacted the sector. But that was followed by a year of dramatic 16% revenue growth as household formation surged at the tail end of the pandemic. Basically, during the pandemic, people moved in together. Then as the pandemic came to an end, those households debundled and apartment demand surged. Barring a significant recession or a major black swan event, average revenue growth should revert to its normal pattern of 3 to 6% annual gains for most property types. But remember, there will likely be substantial variance from market to market. Investors need to monitor the local supply and demand balances for each property type they invest in. And as always, investors need to keep their eyes on the horizon.